Y'all, look, the stock market basically just decided Nvidia is our new Federal Reserve Bank. Because one company comes out, they report earnings, completely crushes it, and suddenly the entire market is saved just like that. But then at the same time, the December Fed meeting, it just got a little bit more messy. Major sectors are screaming of slowdown here pretty soon, and holiday shoppers are straight up letting us know that they're relying more on credit cards heading into the holiday season. And we still don't know if we're getting that October CPI report yet, by the way. So today we'll talk about everything that happened, what all went down, why Nvidia bought the market one more week of oxygen. So today, Nvidia was the news. Earnings. And they reminded everybody that they're the big dog in town. It's being described as having saved the market. So when we compare them to the Federal Reserve, it's because they pretty much bailed out the stock market at this consequential time. They reported earnings with that good story, record revenue, profits up 65%, forward guidance looking good, and either way leading up to it, traders were expecting some type of move in the stock. They seen this 7% swing in volatility either direction, no matter what happened. And what we ended up getting was an early Christmas present from Jensen Wang with a 7.5% move in a $4.5 trillion market cap company. Such a huge company that it moves markets, literally. So it moving the way it did, straight up jumped. We're talking a huge company up 7.5%. Even though the traders were expecting that, that's such a huge move. It caused systemic movement. And that is why we've seen the S&P 500 up after hours. For the whole day, though, up 1.19%. We've seen the NASDAQ 100 up 1.9% about. The Dow Jones up 0.6% about. Even Bitcoin, this one's up 1.48%. So this is all due to Nvidia, that one stock that's able to do that. Because they're the company that people measure how the AI boom's doing. How's the AI narrative? Is it booming still or is it deflating out? And today the confirmation that we got is that the AI demand, it's there. It's very well alive, insanely alive. Margins are holding on strong. And maybe this AI boom isn't over yet. But this is where things get a little weird because, yeah, just because AI is looking strong, these AI leaders are good, doesn't mean the rest of the market's positioned for safety. Yesterday we talked about that B of A's global fund manager survey where these fund managers have cash levels being at their lowest in 15 years. And then we talked about what happens when this happened. Every single time in history so far. Stocks sell off. Treasuries rally. But then today, Morgan Stanley gave this interesting point of view. So they end up getting to talk about how mega cap tech, the biggest companies driving the index, are actually under-owned by large funds, these active funds, relative to their S&P 500 weight. Normally, you'd look at that and you think, oh yeah, that's pretty bullish. That's cash on the sidelines waiting to be deployed. Because maybe these stocks are going to keep on running. The shorts are going to have to cover, like back in the GameStop and AMC days. They're going to eat their words, and they're going to have to FOMO in and buy these stocks up because the performance jitters, it's triggering people to call up their fund manager like, hey, what's going on out there? Like, my grandma could trade stocks better than you. And these underweight positioning creates fuel for these markets because that can be positioned out, creating this buyer demand to go buy mega cap tech stocks. But in my opinion, here's a little flip on that. Fund managers might be underweight on purpose. Like, yeah, it's bullish for some point in the future, but for right now, they're probably positioned the way they are on purpose. And there could be many reasons for that they don't trust, because the economic backdrop is just a little sketchy. And then at the same time, the lack of real data that we have and the visibility on how things are going in the economy. And then the Fed's setup, valuations due to AI, inflation readings are kind of unstable. So yeah, under ownership, it can be viewed as bullish, or giant institutions, just sitting on the sideline with all the advanced data they have, under allocated to mega cap tech. Maybe they see better gains somewhere else, or it's a caution signal. So this can lean either way, but I feel like the caution narrative is just kind of in play right now, even in the consumer showing data that we do get. Because while stocks were flying high today, real households, they're not flying. They're canceling airlines, actually, and they're not even driving their cars because they want to save a couple bucks. They need to save on gas. And Wallet Hub, it had another interesting survey. Today was just completely interesting, and they kind of talked about how 30% of Americans plan to apply for a new credit card for the holiday. Just to buy their family a gift, they got to go into debt. 85% plan on spending the same or less versus last year. 3 of 5 say inflation's cutting into their ability to give charitably. 61%, over half of people out there, wish that the relationships they had in their life didn't have this arranged setup, this tradition of gifting each other stuff, because it costs a ton of money. And 2 and 3 say the economy will make holidays less fun these holidays. So that's not a sign of a healthy consumer we're talking to. That sounds like the consumer whose finances are tight. And it's exactly the type of economic sentiment that quietly echoes what we're seeing from some of these fund managers. And then we also have to get into the problem of the missing data, because the data is this whole gap that gaps uncertainty. That's kind of what it symbolizes. We still don't know when we're going to get certain pieces of data. I think the BLS had this report today. They released some revised news, and they pretty much let us know that we're not going to get this September household survey. At least we don't have that yet. JOLTS for September, that's been delayed. We don't know when we'll get the CPI for October, if we'll get it. Carolyn Levitt kind of made it seem like it's unlikely to get it. And then the September jobs report, which has been delayed for 2 weeks, we're going to get that tomorrow. Economists are expecting to see the number for that come out at 50,000 jobs added. Here, let's make sure. 50,000 up from 22,000 back in August, because we're looking at September's numbers. But we're not getting the household survey, so that means we won't get the unemployment rate, which is what they've already said. And they're saying this data will be folded into the December release over there at the BLS. And that's going to cause December, during the Santa Claus rally, to be this period in time where we get a ton of data to digest all at once. So whipsaw of data. That's probably going to be all over the place. And then, so we got the Fed meeting minutes today for October, and they show something that's incredibly rare, because there's these strongly differing views over there at the Fed. Some governors say the inflation progress has stalled. Some say inflation's basically back to its 2% target right there once you exclude tariff effects. Some want a December cut. Some don't want to cut in December because that December cut would risk unanchoring inflation expectations. And then either way, it seems like we're going to get 3 dissents, because 3 governors appointed by Trump may dissent if they don't want to cut rates. 3 Fed presidents may dissent if they do decide to cut rates. So it's pretty much like they're just down the middle, divided. And I think that goes quite cleanly into the CME Fed Watch tool, which right now the odds of a December rate cut slid to 32.8% for December 10th of that 25 basis point cut. Very likely right now that they're going to pause. But I'd imagine as we get closer to this December meeting and we get a little bit more clarity from that gap of visibility that we have, I feel like that drifts more back to 50-50, which these minutes were the clear sign that the Fed split right down the middle. And that kind of goes down my thesis that this number will go back down to 50-50. And this means that volatility is probably not done, and you should just expect it. And December Fed meeting split right down the middle right now. Volatile. And it's this weird time because then like people get to feeling weird, like with how everything's happening and leading up to today, we've seen weird moves in the CME Fed watch tool. Like it reached a low of 10, its previous low, extreme fear, but we're still in extreme fear, sitting at 11 right now. 1 week ago, we were at 32. 1 month ago, 28. 1 year ago, we were neutral at 50. So for sure, something's happened. And right now, with this CNN Fear and Greed Index being at 11, that's the lowest level since back in April. So something's just going on. So extreme fear, but Nvidia just flew on earnings, completely killed it. This $4.5 trillion company, 7% up. And most of that was in the after hours. Indices moving systemically based off of that. Bitcoin recovered from that slightly. And everybody all over again hyped about this AI trade. So the direction this economy goes, it just kind of depends because it depends on a few different things. Tomorrow will be that delayed jobs report. That'll give us the real first piece of clarity in that direction. But it's still pretty uncertain. So just, stay tuned in, keep on watching, hang out with me a little bit. We'll keep on learning together, y'all. But somebody told me something the other day. They told me to tell you something. That they hope your day is freaking awesome. That you knocked out a whole bunch of stuff today. And that you have a good one.